Capital emerging from Asian markets is a function of globalisation and growth in emerging economies in that geography. China clearly is having a major impact on the region, and new wealth is being created both on a sovereign basis and on a personal basis as well. Sovereign wealth is coming from countries like Malaysia, Korea and China. Individual wealth is coming from Hong Kong, Indonesia and India. Japan has not gone away, but has been less active. And we're seeing signs, however, of more increasing institutional appetite in London from Japan. You only have to look at the Eurozone to see why debt markets are frozen, with European banks taking $1 billion of ECB funding recently. It's abundantly clear that banks are more focused on protecting their capital ratios and surviving sovereign default. New lending to commercial real estate as a business focus becomes less of a priority during such market conditions. That doesn't mean that we're not seeing new entrants like insurers as well as savings banks, who were untainted by the 2008 crash. They're finding the margins and security of conservative commercial real estate lending extremely attractive at present. I've been a long advocate of the view that increasing appetite from new entrants seeking London commercial real estate will keep prime and ultra-prime yields within a relatively tight, stable band over the next 5 years. Ultimately, however, secondary yields will rise. Base rates don't look like moving at present, however at some point they will need to, and logically this should mean that yields will gradually drift upwards. All of the above clearly assumes no further structural event, such as a Eurozone breakup. The City is an easier market to buy in relative to the West End. The West End is a tighter market. The City has more modern stock, higher yields and greater availability. As such, it's an easier market to enter and is therefore becoming more popular by default.